Hi, I'm Peter Williams, founder and CEO of Ace Portal, the hub for private placements. The next series in our video series is about the type of transaction in the private market, whether the transaction is a primary or a secondary transaction, and then whether it's marketed or, frankly, a trade. And it's important to understand each of these, and you're looking at making investments in the private market. So we'll start in the top left. Primary issuance of securities would basically be new securities. They're sold by the company, which in this case would be referred to as the issuer of those securities. And because the company is issuing the securities, the dollars, the cash that's raised goes to a company. So this would be an example if the company wanted to raise $10 or $20 million to build a new production facility, that would be considered a primary issuance. A secondary issuance for trade would basically be a purchase of existing securities. So these would be securities, maybe shares that are already issued to an owner of those shares, and those shares are then sold by that owner to a new owner. In this case, the dollars go from from the buyer to the seller of those securities. The company doesn't get anything out of that. So even if someone was to buy $10 million of shares in a secondary trade, that $10 million does not go to the company. The company's raising no money in that transaction. The next series is marketed versus a trade. So a marketed transaction is just that. Typically the company, it's typically a primary, although you can have some secondary shares as well. So if the company is looking to raise, again, $20 million to build a facility, at the same time some of the family members that own that company want to sell some of their shares, it could be a mix of primary and secondary. Typically they'll prepare information, typically an offering memorandum or a management presentation, documents that investors can review to determine if they want to make an investment in that company. An IPO or a private placement would typically be examples of a marketed transaction. Typical but not required, a marketed transaction would the firm would hire an investment bank. That's very important. The investment bank would come in and do the background due diligence on the company. They prepare all the materials, the private placement memorandum or the documents. They'd ensure compliance with all the securities regulations and close the transaction out. And that's very, very important. We'll get into that a little bit later. A trade, on the other hand, versus a marketed deal would basically be, the best example would be you go on Charles Schwab and you buy, 100 shares of GE. That's a secondary trade. You have access to the same information that every other public investor has access to, and you make a decision whether you think it's a good investment or not, and you buy and sell those securities from other owners of those securities, not from the company itself. So in a public context, again, you all, in theory, have access to equal information. In a private trade, do you have access to equal information? That's a big question. There are some companies out there trying to increase liquidity for secondary shares of private companies, but typically it's a former employee of that company selling shares to someone who doesn't have the same level of information when making that trade. So you're one party would typically be at an advantage and one party would be at a disadvantage. So the moral of the story, when playing in the private market space, you need to be very, very cautious for some of the reasons we outlined. Typically if a firm has hired an investment bank, you're going to probably see the material prepared in a very different way than if the company was to issue it directly. And a lot of these crowdfunding sites out there, what they're trying to do is have the issuer, the company that's seeking to raise the capital, go direct to an investor with really very little interaction in between. And so in theory, there's potentially incentive for the company to portray themselves in the best light without an independent third party reviewing that information at all. And it's just something to be cautious about, and we'll get to that in kind of the next clip. Thanks.